Welcome back to The Deep Dive, your place for cutting through the noise and finding those key insights you need.
Glad to be here.
Today, we're tackling something huge for anyone living or working overseas. You know the feeling, right? You're excited about the new job, the new country,
Yeah, the adventure.
and then bam, that thought hits you. Uh-oh, what about U.S. taxes?
Yeah.
It can feel like a maze, honestly.
Oh, absolutely. It's
Ugh.
complex, and frankly, a lot of folks miss out on some serious tax savings because they just don't know the rules. They end up paying way more than they need to.
And that is exactly why we're diving deep today. Think of this as your roadmap. We're focusing laser sharp on one specific form, Form 25505, Foreign Earned Income.
Yep, this is the big one. It's how you can potentially exclude a big chunk of your foreign earnings and even some housing costs from your U.S. income tax.
We're talking real money back in your pocket, legally. We've dug through the form itself, the official IRS instructions, all that dense stuff.
Right, we've done the legwork so you don't have to wade through it all. We want to pull out the essentials, the pitfalls, the things you really need to know to use this form effectively and save money.
So consider this your shortcut. We'll hit the key facts, maybe some surprising details, and help you avoid that feeling of being totally overwhelmed. Ready to get started?
Let's do it.
Okay, let's lay the groundwork. The star of our show today is Form 25555. For anyone not familiar, what exactly is this form? What's its main job?
Okay, so Form 2555 at its heart is the tool for U.S. citizens and resident aliens to claim two really valuable tax breaks. First, the foreign earned income exclusion, the FEIE,
Right.
and second, the housing exclusion, or sometimes the housing deduction. It's not a standalone tax return. Think of it like an add-on. It gets attached right to your main Form 1040 or 1040 SR.
So it supports the numbers on your main return, but it's not like it makes all your foreign income just vanish for tax purposes, is it? There's a limit.
Precisely. That's a super important point right up front. You cannot exclude or deduct more than your actual foreign earned income for that specific year.
Okay.
So, say the maximum exclusion is, hypothetically, $120,000, but you only earn $90,000 in foreign income that year. Your exclusion is capped at that $90,000. You can't exclude phantom income.
That makes sense. It ties the benefit directly to what you actually earned abroad. Now, before we get into the nitty-gritty of the form, let's just quickly touch on the basic U.S. tax situation for expats. People often assume living abroad means no U.S. taxes, right?
Yeah, that's a common and potentially costly mistake.
Yeah.
The U.S. uses citizenship-based taxation. That means if you're a U.S. citizen or a resident alien, the same basic income tax laws apply to you as someone living stateside.
Wow, so your worldwide income is generally subject to U.S. tax.
Generally, yes. Whether you earned it in Paris, Bangkok, or Buenos Aires, that income is on the U.S. tax radar unless you actively claim things like the exclusions on Form 2555 or maybe foreign tax credits.
Okay, so filing Form 2555 isn't just optional if you want to save money. It's necessary to reduce that U.S. tax obligation on foreign earnings.
Exactly. It's how you tell the IRS, hey, this portion of my income qualifies for special treatment under the rules.
You mentioned U.S. citizens and resident aliens. What's the difference between a resident alien and a non-resident alien for tax stuff? Does Form 2555 deal with that?
Good question. Form 2555 is for citizens and resident aliens. Figuring out if you're a resident alien versus a non-resident alien involves separate rules, like the substantial presence test. That's usually covered in IRS Publication 519.
Ah, okay.
So for today, we're assuming you already know you fall into the U.S. citizen or resident alien category, and now you want to see if you can use Form 25555.
Got it. Now let's talk location. The form is about foreign earned income. What does the IRS actually count as a foreign country? I bet it's not as simple as just not the USA.
You bet right. This definition is surprisingly specific and can trip people up. A foreign country is any territory under the sovereignty of a government other than the United States.
Okay, makes sense.
But it goes further. It includes that country's territorial waters, the airspace above the land and water, even the seabed and subsoil of undersea areas next to their coast, if they have exclusive rights to explore there.
Whoa, okay. So working on an oil rig off the coast of, say, Norway could potentially qualify if it's in their waters.
Potentially, yes. If it's within Norway's legally recognized sovereign territory or designated economic zone. But, and this is key, it specifically excludes places like Puerto Rico, Guam, the U.S. Virgin Islands. Those are U.S. territories.
Right, not foreign.
Also excluded international waters, the airspace over them, and Antarctica. So if you're working on a ship in the middle of the Atlantic, that income isn't earned in a foreign country.
That distinction is huge. If your work location doesn't fit the IRS definition, Form 2555 is basically off the table for that income.
Exactly. No foreign country, no foreign earned income exclusion for that specific work.
Okay, so to actually get these tax breaks, these exclusions and deductions, there are two main hurdles you have to clear. What are they?
Think of them as two essential pillars. Pillar 1, you must pass the tax home test. No exceptions.
Okay, must pass tax home test.
Pillar 2, you must meet either the bona fide residence test or the physical presence test. Just one of those two is enough, but you absolutely need the tax home test first.
Let's break down that first one, the tax home test. This sounds like it's about more than just your mailing address.
Oh, much more. Your tax home isn't necessarily where your family lives or where you vote. It's your regular or principal place of business, employment, or post of duty. Basically where you work.
So if my company sends me to the Tokyo office indefinitely, Tokyo becomes my tax home.
Generally, yes.
Uh,
That's the idea. But here comes the really crucial part, the big potential pitfall.
Uh-oh.
You are not considered to have a tax home in a foreign country if your abode is in the United States.
Abode. What's the difference between a tax home and an abode?
Great question. Your tax home is about your work location. Your abode is more like your street home base. It's where you have your strongest family, economic, and personal ties. Think center of your life.
Okay.
So even if your job, your tax home, is in London, if your spouse and kids live in Chicago, you maintain your main bank accounts in Chicago, you vote in Chicago, the IRS might say your abode is still in the U.S.,
And if your abode is in the U.S.?
then you failed the tax home test for Form 2555 purposes, even if you spend 365 days working in that foreign country. You cannot claim the exclusions.
Wow. That's huge. Can you give us an example to make that really clear? This sounds like where a lot of people could get tripped up.
Definitely. Think about an oil rig worker. Let's say the rig is in the territorial waters of Angola, so technically a foreign location for work.
Okay.
This person works a 28-day on, 28-day off schedule. Every time they're off, they fly back to their family home in Louisiana. They see their family, handle personal business, maintain their life there.
Right. That seems common.
Even though their job site is foreign, the IRS would almost certainly say their abode, their real home, family ties, economic life remains in the United States.
So that worker
Cannot claim the foreign earned income exclusion or the housing benefits because they fail the tax home test due to having a U.S. abode. It's not enough just to work abroad. Your life has to be centered there, too, for the qualifying period.
That's a really critical distinction. It emphasizes that genuine move, that integration, not just being temporarily assigned somewhere while your real life stays back in the U.S. Is there any way around that abode rule?
There is one very specific exception, mainly for military support. If you're a U.S. citizen or resident serving in an IRS-designated combat zone in support of the U.S. Armed Forces, you can potentially qualify even with a U.S. abode.
Ah, okay. A specific carve-out.
Exactly. The IRS puts out a list of these zones. You can usually find it by searching combat zones on irs.gov. But for most civilian expats, that U.S. abode rule is a hard stop.
Understood. So, step 1, establish your tax home and your abode are outside the U.S. Once you clear that hurdle, you move to Pillar 2, meeting either the bona fide residence test or the physical presence test. You only need one, right?
Correct. One or the other. And they're quite different in how you qualify.
All right, let's dig into those qualification tests now. First up, the bona fide residence test. This is covered in Part 2 of Form 2555. Who can actually use this test? Is it for everyone?
Not quite everyone. It's open to U.S. citizens, definitely. But for U.S. resident aliens, there's an extra condition. They can only use this test if they are also citizens or nationals of a country that has an income tax treaty with the U.S.
Ah, okay, so if you're a resident alien, say, from a country without a U.S. tax treaty, you can't use this test. You'd have to rely on the other one, the physical presence test.
Exactly. That treaty requirement is a key filter for resident aliens wanting to use the bona fide test.
Okay, assuming you're eligible, what's the main requirement? The name bona fide residence sounds less like counting days and more about genuine living situation.
That's spot on. It's not about hitting a specific day count like the other tests. It's about proving you are a genuine resident of a foreign country, or maybe multiple foreign countries, for an uninterrupted period that includes one entire tax year.
An entire tax year. So January 1st through December 31st if you're a calendar year filer.
Yes. That full calendar year has to be contained within your period of bona fide foreign residence. Your residency period might start before that year or end after it, but it must continuously cover that whole Jan 1st to December 31st span.
And how does the IRS figure out if your residence is bona fide or genuine? Do they just take your word for it?
Definitely not just your word. They look at your intentions about the length and nature of your stay. And crucially, they say your actions speak louder than your words.
Okay, so what actions are they looking for?
Things that show you've really integrated and made the foreign country your home, at least for an indefinite period. Did you buy a house or sign a long-term lease? Did you bring your family? Do you participate in the local community? Get a local driver's license. Join clubs.
So it's about demonstrating roots, even if temporary ones.
Exactly. If you just go over for a specific short-term project with a clear end date, intending to come right back, that usually doesn't qualify as bona fide residence. It needs to feel more open-ended, more like establishing a real home abroad.
This explains why Part 2 of the form asks those specific questions. Like on line 10, it asks for the dates your bona fide residence began and ended.
Right, that establishes the timeline for that uninterrupted period. If you're still a resident, you just write continues.
And line 11 asks about your living quarters, purchased, rented, employer provided. That seems to go straight to the actions speak louder point.
Absolutely. Buying property is a much stronger indicator of indefinite intent than, say, a short-term Airbnb. Renting a regular apartment falls somewhere in between. It helps build the picture.
Lines 12A and 12B ask if your family lived with you abroad. Why is that relevant?
Again, it points to the nature of your stay. If your spouse and kids are with you, attending local schools, etc., it strongly suggests you've established a genuine home base abroad, not just a temporary work camp. It strengthens your case for bona fide residence.
Now, lines 13A and 13B look really important. They ask if you've told the foreign authorities you weren't a resident, and if you're required to pay foreign income tax there. This sounds like that trap you mentioned earlier.
This is it. This is the big one for the bona fide test.
Yeah.
If you submitted a statement to the government of the country where you're claiming bona fide residence, saying, hey, I'm not a resident here, perhaps to avoid their taxes,
Yeah.
then the IRS says, okay, fine, you told them you're not a resident. Then you're not a bona fide resident for U.S. tax purposes either.
Yeah.
You cannot claim non-residency to the foreign country and simultaneously claim bona fide residency to the U.S. for the same period.
Wow. So you have to be consistent. If you want the U.S. tax benefit of being a bona fide resident, you generally have to accept the potential tax obligations of being a resident in that foreign country.
That's the crux of it. Trying to play both sides here will disqualify you from using the bona fide residence test. It's a critical check.
Okay, that's a vital piece of tax-saving strategy. Don't undermine your U.S. claim by trying to avoid foreign tax status. What about line 14, asking about days and income earned in the U.S.?
Right, you have to list any time spent back in the U.S., during the year dates, number of days on business, and crucially, any income earned while on business in the U.S.
And that U.S. earned income.
Is not foreign earned income. It cannot be excluded using Form 2555. It gets reported normally on your Form 1040. This line helps the IRS track that separation.
Makes sense. And line 15 asks about contract terms, visa type, and maintaining a U.S. home. More clues about intent.
Exactly. A contract with a very fixed short duration or a visa type that only allows a brief stay might suggest your stay isn't indefinite, weakening the bona fide claim. And maintaining a home in the U.S. who lives there, is it rented out, goes back to that abode question and where your true ties lie. It all contributes to the overall picture of your residency status.
So the bona fide test is really about demonstrating a genuine, established, and somewhat indefinite life abroad, backed up by consistent actions.
That's a great summary.
Now let's switch gears to the other option, the physical presence test in Part 3. This one sounds more like a math problem.
It largely is, and importantly, it's available to all U.S. citizens and all U.S. resident aliens, regardless of tax treaties. So it's often the go-to for resident aliens who can't use the bona fide test, or for anyone whose situation is more about time spent abroad than indefinite residency.
Okay, so what's the magic number? How many days do you need?
The core requirement is that you must be physically present in a foreign country or countries for at least 330 full days during any period of 12 consecutive months.
330 full days. And define full day for us again.
A full day is a continuous 24-hour period starting at midnight. If you spend any part of a day traveling over or within the United States or its waters, that day does not count as a full day of foreign presence.
Okay, strict 24-hour definition. Do those 330 days need to be all in a row? What about trips back home for holidays or business?
No, and this is a key flexibility. The 330 days do not have to be consecutive. You can come back to the U.S. for a few weeks, travel to other countries. As long as the total number of days you are physically in one or more foreign countries adds up to at least 330 within your chosen 12-month period, you meet the test.
That's a relief for many, I'm sure. So line 16 on the form asks for the specific 12-month period you're using for this test. How do you pick that period? Does it have to match the 2024 calendar year?
No, it doesn't have to be Jan 1st to Dick 31st. You choose any 12 consecutive month period that allows you to meet the 330-day requirement. The only rule is that part of that 12-month period must fall within the tax year you're filing for, 2024 in this case.
So I could use, say, April 1, 2023 to March 31st, 2024, or maybe September 1, 2024 to August 31st, 2025.
Absolutely. You pick the 12-month window that maximizes your qualifying days for the 2024 tax year. And unlike the bona fide test where you might put continues, here you must enter specific start and end dates for that 12-month period.
Got it. Line 17 asks for your principal country of employment. Straightforward enough. But then line 18 requires a detailed travel schedule. This sounds like where good record keeping becomes absolutely critical for tax savings.
It's non-negotiable for this test.
You-
You need a meticulous log. For every trip you took during your chosen 12-month period, you need to list the country, arrival, and departure dates, the number of full days you were present in that foreign country.
Whoa.
Any days spent in the U.S. on business, and again, any income earned while on business in the U.S. That U.S. earned income is separate, reported on the 1040, not excluded here. This travel log is your proof that you met the 330-day threshold.
So hanging on to flight confirmations, calendar entries, passport stamps, all that stuff is vital.
Essential. Without that proof, the IRS could potentially disallow your claim under this test.
Okay. Now, what if something unexpected happens, like war or civil unrest or some disaster forces you to leave the foreign country before you hit the 330 days or finish the full tax year for the bona fide test? Are you just out of luck?
Thankfully, no. There's a waiver for the time requirements in those kinds of specific adverse situations. If you had your tax home established in that foreign country and reasonably expected to meet the time tests, but had to leave because of these conditions,
Yes.
the IRS may waive the minimum time requirement. You'd still only get the exclusion for the income earned during the time you were actually there, but you wouldn't lose the benefit entirely just because you were forced out early.
How do you know if your situation qualifies for the waiver?
The IRS publishes an official list each year, naming the specific countries and the eligible dates where conditions warranted evacuation. If you left one of those countries during the specified period, you can potentially claim the waiver.
And how do you claim it on the form?
You need to write claiming waivers right at the top of page 1 of Form 2555. You also need to attach a statement explaining how you met the requirements for the waiver that you expected to meet the time test, but couldn't because of the adverse conditions. It's a really important safety net.
Good to know. One last check on qualifications. Are there any specific countries, like Cuba, where travel restrictions might impact things?
Yes, absolutely. U.S. travel restrictions regarding Cuba are directly relevant. If you spent time in Cuba in violation of U.S. travel rules, that time generally cannot count towards meeting either the bona fide residence or physical presence tests.
And the income earned there?
Also generally not considered foreign earned income for exclusion purposes, and housing expenses there wouldn't qualify either. The only exception noted is for work performed at the U.S. Naval Base at Guantanamo Bay. That's not considered a violation.
Okay, another specific detail to be aware of. So, nailing down your qualification under one of these tests is the absolute key to unlocking the door for tax savings.
It's the gateway, exactly.
All right, assuming you've successfully passed the tax home test and met either the bona fide residence or physical presence test, let's get to the good part. What income actually counts as foreign earned income? This is part 4 of Form 2555, and it defines the pool of money you can potentially exclude.
Precisely. This is what the Foreign Earned Income Exclusion, FEIE, applies to. Generally, it's your pay for personal services performed in a foreign country during that period you qualified. So think wages, salaries, commissions, professional fees, bonuses. Basically, compensation for your work effort abroad.
Seems clear for a regular salary. But what about other types of compensation, like benefits or non-cash things your employer provides? What gets included there?
Good question. Because it's broader than just your paycheck. It includes the fair market value of non-cash benefits provided by your employer because of your work. Things like
Like what?
the value of a company car provided for your use, or employer-provided housing, unless it's excluded under a different, stricter rule we'll touch on, or even meals provided on site.
Yeah.
It also explicitly includes common expat allowances, cost of living adjustments, overseas differentials, family allowances, education allowances for kids, funds for home leave travel, housing allowances, and even payments under tax equalization plans. All that gets added into your total foreign earned income figure.
That's pretty comprehensive. It captures a lot of the extra compensation people get for working overseas. What about self-employed folks? How is their income treated, especially if their business involves capital, not just their services?
Right, self-employment income has a couple of wrinkles. If your business is unincorporated and capital, like inventory or major equipment, is not a major income-producing factor, think consultants, writers, programmers, working mostly with their skills,
Yeah.
then generally 100% of your gross income from that business counts as earned income. That's a great scenario for many service-based freelancers or sole proprietors abroad.
But what if capital is a big factor, like owning a shop or a small factory?
Then the rule changes significantly. If capital is material to producing income, you can only treat a reasonable amount as compensation for your personal services as earned income. And the IRS puts a cap on that reasonable amount.
What's the cap?
It cannot be more than 30% of your share of the net profits of that business after you've already taken the deduction for 1/2 of your self-employment taxes.
Only up to 30% of net profits. That's a major limitation for capital-intensive businesses abroad. It means most of the profit isn't eligible for the FEIE.
Exactly. It prevents business owners from excluding large amounts of profit that are arguably returns on capital, not just payment for their personal labor. It's a key distinction for self-employed tax-saving strategies.
Okay, that's crucial. Now, just as important is knowing what doesn't count as foreign earned income. What kinds of income are specifically excluded from this definition, meaning you can't use the FEIE against them?
Yeah, knowing the no list is vital. Foreign earned income does not include things like pension or annuity payments, including Social Security.
Right, retirement income is different.
Investment income interest, dividends, capital gains, that's passive income, not earned from services. Alimony received.
Okay.
And this is a big one. Amounts paid by the U.S. government or its agencies if you're a direct employee. So most federal workers abroad cannot use Form 2555 for their government salary.
Because their employer is the U.S. government itself, not a foreign entity.
Precisely. Also excluded is income received too late, specifically after the end of the tax year following the year you actually perform the services, and certain employer contributions to retirement plans like non-exempt trusts or non-qualified annuities.
That's a clear list of what's out. Trying to exclude any of those would be a mistake. What about timing for cash basis taxpayers? If I did work in late 2023 but got paid in early 2024, when does it count?
Generally, you report income when you receive it. So the payment received in 2024 would typically be 2024 income. However, the rules allow income received in the year after services are performed to be considered earned in the year received, if it's received by the end of that following year.
So that 2023 work paid in early 2024 could potentially be 2024 foreign earned income.
It could, yes, which helps align the income with the potential exclusion period. But if income relates to a prior year's services and you qualified for exclusion then, but didn't claim enough, you might need to look at amending that prior year's return, Form 1040X, rather than just lumping it into the current year. Timing can get complex, and it might mean going back to fixed past returns to maximize savings.
Good point. Always keep good records of when work was done versus when payment was received. Now, line 25 on the form mentions excludable meals and lodging. How is this different from the housing exclusion we'll talk about later?
This is a separate, much narrower rule under Section 119 of the Tax Code. It's not the general housing exclusion. This applies only if meals and lodging are provided. 1. For the convenience of your employer. 2. On the employer's business premises. 3. And lodging must be required as a condition of employment.
So like living in a company-provided camp in a remote mining area.
Exactly. Think very specific situations where you have to live right there to do the job. If meals and lodging meet these strict tests, their value can be excluded from your income before you even calculate the main FEIE or housing exclusion. It's an additional potential saving, but it doesn't apply to most typical expat housing situations.
Got it. Distinct from the main housing calculation. Okay, now we're getting to the heart of the tax savings, the exclusions themselves. The foreign income exclusion, FEIE, and the housing exclusion deduction. These are the big levers.
These are the main events, absolutely. The FEIE lets you take a big slice of that foreign earned income we just defined and make it disappear from your U.S. taxable income up to a limit.
And the housing exclusion or deduction?
That helps offset the often high cost of housing abroad, either by excluding amounts your employer provides for housing or allowing you to deduct some of your housing expenses. Used together, These can lead to massive U.S. tax reductions.
Let's tackle the FEIE first. This is calculated in Part 7, the Form 2555. What's the maximum exclusion amount for 2024? This is the number everyone wants to know.
Okay, drum roll. For the 2024 tax year, the maximum foreign earned income exclusion is $126,500.
$126,500. That's a significant amount of income you could potentially pay zero U.S. tax on.
It's substantial, yes. That's the ceiling. If you qualify for the entire tax year, you'd put that figure on line 37 of the form.
But what if you didn't qualify for the whole year? Maybe you moved mid-year or only met the physical presence test for part of the year. Does the limit get reduced?
Yes, absolutely. This is really important. If your qualifying period at the time you met the tax home test and one of the residence presence tests doesn't cover all 366 days of 2024, it's a leap year.
Right.
Then that $126,500 maximum must be prorated. The form walks you through this on lines 38 to 40. You figure out the number of qualifying days you had within the 2024 tax year.
Okay, so you count the days.
Then you divide that number by 366. That gives you a fraction, or a percentage. You multiply the full $126,500 by that fraction to get your personal maximum exclusion limit for the year.
Can you run through a quick example? Say someone qualified starting July 1st, 2024.
Sure. July 1st to December 31st, 2024 is 184 days. So you take 184 divided by 366, which is roughly 0.5027, multiply $126,500 by 0.5027, and your maximum exclusion for 2024 would be about $63,590.
So less than half the full amount because they were only qualified for about half the year. Getting those qualifying days right is critical for maximizing the tax savings.
Absolutely critical. Your actual exclusion on line 42 is then the smaller of either this prorated maximum limit or your actual foreign earned income for the year, after subtracting any housing exclusion, which we'll get to.
Right. Can't exclude more than you earn. What about married couples? If both spouses work abroad and qualify, do they share one exclusion or?
Good news here for working couples. Each spouse who qualifies figures their FEIE separately, based on their own foreign earned income. Community property laws don't apply here.
So if both spouses qualify and meet the test, they could potentially exclude up to $126,500 each, assuming they both earned at least that much abroad and qualified for the full year.
That's correct. They each calculate their own exclusion on their own conceptual form, 25505, Part 7, and the total combined exclusion goes onto their joint return. It's a powerful benefit for dual-income expat couples.
Very powerful. Okay, let's move to the other major tax saver, the housing exclusion and deduction. These are covered in Part 6 and IX. This helps with rent, utilities, etc., right? Especially in expense cities.
Exactly. Housing is often a huge expense for expats. This part of the form helps offset that. First step is figuring out your qualified housing expenses on line 28.
What counts? What should people be keeping track of? Rent, obviously.
Rent, yes. Also reasonable costs for utilities like electricity, heat, water, but usually not telephone or TV internet unless it's required for work. Also property insurance, minor repairs, furniture rental, non-refundable fees for getting a lease, even residential parking fees.
What about the value of housing provided by your employer?
Yes, the fair rental value of employer-provided housing, in-kind housing, can also be included here, unless you already excluded it under that very strict Section 119 rule we talked about earlier.
Okay. And what's definitely not included, what expenses should people not put down here?
This is important to get right. You cannot include costs that are deductible elsewhere, like mortgage interest or real estate taxes. Those go on Schedule A if you itemize.
Right.
Also out. The cost of buying property, major improvements, principal payments on a mortgage, depreciation. You can't deduct the cost of purchasing furniture or paying for domestic help like maids or gardeners. And critically, only expenses paid or incurred during your qualifying period count.
Makes sense. There's also a mention of a second foreign household. When might that apply?
That's a very specific exception. It applies if living conditions at your main foreign tax home are dangerous, unhealthy, or otherwise adverse, forcing you to maintain a separate, safer household elsewhere in a foreign country for your spouse and dependents. Only then could you potentially include expenses for both households.
Okay, a hardship provision. Now, a huge factor here is the housing expense limit, mentioned around lines 29 NAB. This isn't the same for everyone, is it? It depends on where you live.
Absolutely. This is where location becomes critical for maximizing savings. There's a general limit, which for 2024 is based on 30% of the maximum FEIE, so $37,950 for a full year, or about $103.69 per day if you qualify for less than the full year.
What?
But the IRS recognizes that housing costs vary wildly, so they publish a list every year for 2024. It's Notice 2024-31 that provides much higher housing expense limits for specific high-cost locations around the globe.
So if I live in, say, Hong Kong or Geneva or London.
You absolutely need to check that notice. Your location-specific limit could be significantly higher than the general $37,950. It might be $80,000, $100,000, even more in some super expensive cities. Using that higher limit lets you potentially exclude and deduct much more of your actual housing costs.
That's a massive potential tax saving right there, just by knowing your specific location's limit. What if you lived in multiple foreign locations during the year?
You'd prorate the limits for the time spent in each location and use a worksheet provided in the instructions to figure out your combined limit. And keep an eye out, the IRS sometimes allows you to elect to use the next year's limits, so 2025 limits for your 2024 return, if they anticipate those will be higher. That's another potential planning opportunity.
Good tip. Then comes the base housing amount on line 32. For 2024, it's $20,240 for a full year, or $55.30 per day. Why do we subtract this base amount?
Think of the base amount as the portion of housing costs the IRS considers standard or non-excludable. It's roughly 16% of the maximum FEIE. The idea is that the housing exclusion deduction is meant to offset the excess cost of housing abroad, not the basic cost everyone incurs. So you only get the tax benefit on qualified expenses above this base amount.
Okay, so it targets the extra burden of foreign housing. Makes sense. Next, line 34 talks about employer-provided amounts. What goes into this number?
This includes any amounts your employer gave you that are considered foreign earned income and intended to cover housing, or just general compensation. So your salary, any specific housing allowance, reimbursements for housing or education, payments under tax equalization plans, even the fair market value of that in-kind lodging if it's included in your income.
This links the housing benefit back to what your employer provided. Now, what if you're self-employed? You mentioned they don't use the exclusion.
Correct. If all your foreign earned income is from self-employment, you have no employer-provided amounts in the traditional sense. So you skip the housing exclusion calculation in Part 6 entirely.
And instead,
You go straight to Part 9 to figure the housing deduction. The exclusion is tied to employer funding. The deduction is for everyone else, including self-employed, with qualifying excess housing costs.
crucial split there for the self-employed. Okay. For those with employer-provided amounts, how do they calculate the actual housing exclusion on line 36? It looks like a formula.
It is. Basically, you first figure out your housing costs that are above the base amount, line 33, the smaller of your qualified expenses or the limit, minus the base amount. Then you compare that excess amount to your total employer-provided amounts, line 34. The exclusion is generally the smaller of those two figures. There's a slight nuance if employer amounts are less than total foreign income, requiring a fraction, but the form guides you. Essentially, it limits the exclusion to the lesser of your excess housing costs, or what your employer effectively funded.
So the exclusion can't be more than your employer provided towards your income housing. Got it. Now, if you still have housing costs left over after the exclusion, or if you're self-employed, you look at the housing deduction in Part 9. When does this apply?
You can only take the housing deduction if two things are true. First, you have excess housing costs remaining after calculating any housing exclusion. This amount is carried from line 33 or figured separately if self-employed. Second, you must still have foreign earned income left over after subtracting both the FEIE, line 42, and any housing exclusion, line 36.
So you need leftover housing costs and leftover taxable foreign income to deduct again.
Exactly. The deduction uses up those remaining housing costs against that remaining taxable income.
And how much can you deduct? What's the calculation on line 48?
It's simple at this point. The deduction is the smaller of your remaining excess housing costs from line 47 or your remaining taxable foreign earned income from line 46. It directly reduces your adjusted gross income, AGI, on your Form 1040.
A direct deduction from income is always good for tax savings. What about carryovers? If my excess housing costs are huge one year, maybe more than my remaining income, can I save that leftover deduction for next year? Lines 49-50 seem to address this.
Yes, there's a carryover, but it's limited. You can carry over any housing amount you couldn't deduct this year because you didn't have enough remaining income to your next tax year only.
Only 1 year.
Only 1 year. So undeducted amounts from 2023 can be carried into your 2024 calculation, line 49. Any undeducted amounts from 2024, line 50, could be carried over to 2025, but no further. If you can't use it in that immediately following year, the potential deduction is lost forever.
That's a tight window. You really need to plan to utilize that carryover in the very next year. It adds pressure to maximize its use quickly.
It definitely does. It's not an indefinite carry forward like some other tax attributes.
Okay. And quickly, for married couples in housing, does it matter if they live together or apart?
Yes, it does.
Yeah.
If they file jointly and live in the same foreign household, they figure their housing amount jointly, but only one spouse claims the exclusion or deduction. They essentially combine their expenses and limits.
And if they live separately?
If they maintain separate foreign households, they can each claim expenses for their own household, but only if their tax homes aren't within reasonable commuting distance of each other, and their households aren't within reasonable commuting distance of the other spouse's tax home.
So truly separate work locations and living situations.
Right. If they just live apart for convenience, but could reasonably commute, then generally only one spouse can claim the housing benefits, similar to living together, prevents doubling up unnecessarily.
All right, we've covered how to qualify and how to calculate these major exclusions, but claiming them isn't without consequences for other parts of your tax return, right? Part 8 touches on the impact. What's the big picture here?
The big picture, and this is crucial for your overall tax-saving strategy, is that you generally can't double dip. If you exclude income using the FEIE, or the housing exclusion, you cannot also take deductions, credits, or other exclusions that are directly related to that excluded income.
So if income isn't taxed, you don't get tax breaks related to earning it.
Exactly. And if only part of your income is excluded, then any related deductions or credits usually have to be prorated, reduced proportionally, based on how much income was excluded versus taxed.
What are some specific common deductions or credits that get impacted? Where do people need to weigh the trade-offs?
Okay, several big ones. Additional child tax credit. Huge for families. You cannot claim this refundable credit if you claim either the FEIE or the housing deduction. That could be a significant loss.
Wow, okay.
Earned income credit. Same deal. Claiming the FEIE or housing deduction makes you ineligible for the EIC, another major credit for lower to middle income earners. Foreign tax credit or deduction. This is probably the most complex interaction. You cannot claim a foreign tax credit on Form 1116 or deduction for foreign taxes paid on income that you excluded using the FEIE or housing exclusion.
So no U.S. tax on the income via exclusion means no U.S. credit for foreign taxes paid on that same income.
Correct. If you exclude all your foreign earned income, you get zero foreign tax credit for taxes paid on that income. If you exclude only part, you have to carefully allocate your foreign taxes between the excluded and non-excluded income, only claiming a credit on the taxes related to the non-excluded U.S. taxable portion. This requires careful calculation and understanding of Form 1116 rules.
That interaction between the exclusion and the foreign tax credit is critical. Sometimes it might even be better to not claim the exclusion and just claim the full foreign tax credit, especially if foreign taxes are very high.
That's absolutely a strategic decision expats need to consider, sometimes running the numbers both ways. Also, claiming the exclusions can affect your ability to deduct IRA contributions. Special rules apply there too.
So it's not just about the exclusion amount itself, but its ripple effect across your whole tax return. The final excluded amount from Form 2555, line 45, goes on to Schedule 1 of the 1040. How does that mechanically reduce your income?
It's entered as a negative number on Schedule 1, Form 1040, line 8T, under Other Income. This directly subtracts from your total income, lowering your adjusted gross income, AGI. A lower AGI is generally beneficial for tax purposes.
Okay, here's a mind bender I've heard about. When the IRS calculates the tax on your non-excluded income, does the excluded income just vanish, or does it still kind of count?
Ah, yes, the stacking rule. This catches so many people by surprise. Your excluded income does not simply vanish for rate calculation purposes. You figure the tax on your remaining non-excluded income using the tax rates that would have applied if you hadn't claimed the exclusion.
Wait, so the excluded income still pushes your taxable income into higher tax brackets?
Precisely. Imagine your income like blocks. You remove the excluded blocks from being taxed, but they still count towards the height of the stack, determining the marginal tax rate that applies to the blocks still left on top.
That significantly dampens the benefit compared to if the income just disappeared entirely for bracket purposes.
It does. It means your non-excluded income gets taxed at a higher marginal rate than it would if the excluded income truly didn't exist. The IRS has a specific worksheet, the Foreign Earned Income Tax Worksheet in the 1040 instructions, to handle this calculation correctly. It's a crucial detail.
Wow, that's vital to understand for realistic tax planning. Okay, making the choice to claim these exclusions, is it a year-by-year decision, or are you locked in? Can you revoke it?
You make the initial choice on your return, typically a timely filed one or an amended one. Once made, that choice stays in effect for that year and all future years, unless you formally revoke it.
How do you revoke it?
You attach a statement to your return for the first year. You don't want the exclusion to apply, explicitly stating you're revoking your previous election.
And is there a catch if you revoke?
A big one. If you revoke the choice, you are generally barred from claiming those exclusions again for the next 5 tax years, unless you get special permission from the IRS.
5 years, that's a long time to be locked out of potentially huge tax savings. So revoking is a major decision with long-term consequences.
Absolutely. You wouldn't revoke lightly. However, if you just have a year with no foreign earned income, you don't need to revoke. The election remains. There's just nothing to exclude that year.
Good clarification. Finally, the practical stuff. When and where do you actually file Form 2555 and the associated 1040?
Okay, the standard deadline is April 15th. But if your tax home and abode are outside the U.S. and Puerto Rico on April 15th, you get an automatic 2-month extension to file until June 15th or June 16th, 17th, depending on weekend holidays.
Automatic extension just for being abroad.
Yes, but you need to attach a statement confirming you meet those conditions. Importantly, this extends the time to file, but not the time to pay. Interest still starts accruing on any tax due from the original April 15th deadline.
Good warning. Pay by April, file by June if needed. What if you haven't met the bona fide or physical presence time test even by the June deadline? Maybe you moved late in the year.
Then you can request a further special extension using Form 2350, Application for Extension of Time to File. You file this before the June deadline, explaining you expect to qualify for the exclusions but need more time to meet the tests.
So, Form 2350 buys you more time specifically to meet the residency presence requirements.
Exactly. Or the alternative is to file your return on time by June 15th without claiming the exclusion, pay any tax due, and then file an amended return, Form 1040X later, once you do meet the tests, to claim the exclusion and get a refund. That avoids failure to pay penalties.
Options for flexibility and the mailing address. Does it go to the regular IRS center for your state?
No, this is another common mistake. You attach Form 2555 to your 1040-1N010-0SR, but you must mail it to a specific IRS address designated for international filers, usually in Austin, Texas, or Kansas City, Missouri, depending on whether a payment is enclosed. Check the Form 1040 instructions or the IRS website for the exact correct address for Form 2555 filers. Sending it to the wrong place will cause major delays.
Crucial piece of practical advice. Use the special international address. Wow. Okay, we have covered a ton of ground. From understanding the basics, what's a foreign country, what's foreign earned income, through the vital qualification tests like tax home, bona fide residence, and physical presence,
all the way to calculating the actual foreign earned income exclusion, the housing exclusion, the housing deduction, understanding the limits, the prorations, the base amounts.
and finally, understanding the impact on other tax credits, the stacking rule for tax rates, how to revoke, and the practicalities of filing deadlines and addresses. Form 2555 is definitely complex, but clearly so powerful for saving money.
It really is. Getting these details right, carefully tracking your days, your expenses, understanding the definitions and limits, and especially knowing those crucial trade-offs with things like the foreign tax credit. That's the key to unlocking potentially thousands of dollars in legitimate U.S. tax savings. It requires diligence, but the payoff can be huge.
Absolutely. Well, that wraps up this deep dive into Form 2555. We hope this detailed walkthrough helps you navigate your U.S. tax obligations while living abroad more confidently.
Definitely. Knowledge is power here.
So here's something to think about. Considering all these intricate requirements, the abode rule, the residency tests, the specific income definitions, and the very significant financial benefits available, how might a truly deep understanding of your global footprint reshape not just your immediate tax filing, but maybe your broader financial planning and even lifestyle choices for the future?
Something to definitely mull over.